Good morning, everybody. The March 7, 2017 School Land Board meeting will now come to order. First item on the agenda is approval of the minutes from our last meeting on February 21. After the board has had a chance to review said minutes and assuming no questions, comments, or objections, I can entertain a motion to approve these minutes.
So moved.
Second.
Motion is made, seconded, and carried unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda as posted. Once again, if the board has no questions, comments, or objections to the consent agenda, and not hearing any last-minute changes to that consent agenda, I can entertain a motion to approve said agenda.
So moved.
Second.
Motion is made, seconded, and carried unanimously to approve the consent agenda as posted. Next item through item number 5 will be an executive session. We will enter said session under Chapter 551, Subchapter D, Section 551, Tech 071 of the Texas Government Code for discussion and consideration regarding pending or contemplated litigation or settlement offers. We'll also seek attorney advice and counsel related to items 3 through 5 on the docket pursuant to subsection 551, Tech 072 for the discussion and consideration concerning purchase, sale, exchange, lease, or value of real property related to items 3 through 5 on the docket. Following executive session will come out in open session to complete the docket. The open session of the March 7, 2017 School Land Board meeting now will resume with item number 3.
Good morning. Amber Long, Asset Management. Staff recommends approval of the disposition of tax foreclosure land per the terms discussed in closed session. Any questions?
So moved.
Second.
Motion is made, seconded, and carried unanimously to approve item number 3. Thank you, Amber. Next item on the agenda is number 4.
Thank you, Mr. Chairman, members. For the record, Rusty Martin, Chief Investment Officer. Item number 4 is approval of an agenda item that would constitute your approval of an investment by the GLO on behalf of the Permanent School Fund in Lion Industrial Trust. The IAC is recommending that TexGlo invest $75 million on behalf of the PSF in Lion. Just for the record, the Lion's an $8.8 billion gross asset value, core plus open-end real estate fund that focuses on acquiring or developing high-quality bulk distribution and warehouse assets in primary markets that benefit from the proximity to large population bases and major transportation nodes. The investment management staff initially discussed the Lion proposal with Townsend in mid-January of this year. Thereafter, comprehensive due diligence materials were submitted to investment management staff and Townsend by principals of the fund sponsor, which is Clarion Partners. A due diligence call was held with various participants from investment management, Townsend, and Lion on February the 8th. Investment management staff then worked with Townsend to perform further due diligence on Lion during January to February, and Townsend submitted a comprehensive due diligence report on Lion in February. In addition, Lion principals made a detailed presentation to the IAC and to Townsend at our offices on February the 22nd. In conjunction with this ongoing discussion, review, and analysis, investment management staff worked with Townsend and legal counsel to ensure that the investment fits within the framework of the TexGlo PSF real assets investment policy statement and is in the best interest of the Permanent School Fund. Therefore, the IEC is recommending that the School Land Board approve the investment of $75 million in Lion Industrial Trust, and I'm happy to answer any questions.
So moved.
Second.
Motion is made, seconded, and carried unanimously to approve item number 4. Next item on the agenda is number 5 as stated.
Thank you, Mr. Chairman. Members, approval of this item would constitute your approval of a co-investment by the General Land Office on behalf of the Permanent School Fund alongside First Reserve Fund 13 through a newly created co-investment structure called Capital Co-Investments 13 LLC. The IAC is recommending that you approve a co-investment of up to $100 million alongside First Reserve 13 through Capital Co-Investments 13. For background purposes, the board currently has a $100 million capital commitment to Fund 13 and $225 million in capital commitments to First Reserve Infrastructure Funds 1 and 2, which are also sponsored by First Reserve Corp. They focus on providing investment capital to the upstream, midstream, and services sectors of the global independent energy industry. In addition, the board has a $100 million U.S. upstream co-investment alongside First Reserve 13 through Capital Co-Investments 9, LLC, and a $75 million U.S. midstream co-investment alongside First Reserve 13 through Capital Co-Investments 10, LLC. First Reserve has recently identified a very attractive investment opportunity in the upstream space that requires capital in addition to the amount committed by Fund 13. Therefore, it has solicited a select group of interested potential co-investment partners from within the pool of Fund 13 limited partners to participate in the transaction. Fund 13 representatives initially presented details of the proposed co-investment to investment management staff in late January of this year, and comprehensive due diligence materials were subsequently made available to investment management staff in the Townsend Group for review and analysis. The comprehensive due diligence call was later held with Fund 13 representatives in Townsend on February the 8th of this year. Subsequent to that call, investment management staff discussed the proposed co-investment with W.D. Von Gotten and Associates, which, as you know, is a premier oil and gas consultant located in Houston. Fund 13 representatives then made a detailed presentation to the IAC and to Townsend on February the 22nd. In conjunction with this review and analysis, investment management staff and the IAC have determined that the proposed co-investment fits within the framework of the TexGlobe PSF Real Assets Investment Policy Statement and is in the best interest of the Permanent School Fund. Therefore, the IAC recommends that the School Land Board approve a co-investment of up to $100 million in the proposed transaction alongside First Reserve 13 through Capital Co-Investments 13 LLC, and I'm happy to answer any questions.
Any questions from the board?
So moved.
Second.
Motion is made, seconded, and carried unanimously to approve item number 5. Final item on the agenda is number 6.
Thank you, Mr. Chairman. Members, for the record, this is a non-voting item. I'm pleased to present you with a quarterly investment report for the Permanent School Fund's Real Assets Investment Portfolio for the period July 1 through September 30, 2016. The performance measurement calculations and the statistical data that are presented in the QAR were prepared by State Street Bank and its Private Edge Group, which are the custodial accounting and performance measurement agents for the portfolio. I'll give you a brief market summary before we start talking about the returns on the portfolio. Basically, in the third quarter, U.S. GDP increased an annual rate of 3.5% after increasing 1.4% in the second quarter, and it was its best performance in 2 years. Also, during the period, the unemployment rate remained unchanged at 4.7% from second quarter. Fed policy was also unchanged during the quarter. The Fed left its Fed funds rate target at 0.25 to 0.5%. They also maintained their policy of reinvesting principal payments from its holdings in agency mortgage-backed securities and rolling over maturing Treasury securities at auction. Although Chairwoman Yellen indicated in August 2016 that the case for interest rate hikes had strengthened, the Fed continued to expect that economic conditions will evolve in a manner that warrants only gradually increases in the Fed funds rate. The actual path of those increases will depend on the economic outlook indicated by incoming economic data. As we know, in December, the Fed did raise rates by a quarter, and we expect that in March they probably will raise by another quarter. So they've established a path, and they seem to be sticking to that path. As far as real assets are concerned, in the commercial real estate market, as measured by NPI, it returned 1.77% for the quarter, ended September 30th. Its trailing one-year return was 9.22%. All of the quarterly individual sector returns were positive for the 26th time since the second quarter of 2008. Industrial and retail were the best performers. In the energy markets, WTI oil prices fluctuated between $43 to $45 for most of the period, but ended virtually unchanged for the quarter at $48.24 a barrel. Prices were influenced by two primary factors. Number one, OPEC announced that it would consider curbing production in order to accelerate the unwinding of the global oil glut. And secondly, the IEA reported that global demand continued to weaken with year-over-year demand growth easing every quarter that to settle at about 800,000 million barrels per day, and compared to about 2.3 million barrels per day in second quarter of 2015. It's not 800,000 million, 0.8 million. Despite the OPEC announcement, most analysts remain skeptical that OPEC members would adhere to any planned reductions going forward, particularly since the deal is also contingent upon Russia, the largest OPEC member, agreeing to freeze or cut its own production. Of course, we know now that they did go ahead and take that action, and so far it seems that most of the members are adhering to those freezes. Natural gas prices spent most of the quarter between $2.75 and $3 per million BTUs, and averaged $2.87 for the period. Average prices were up about 34%. That's due mainly to the summer's much warmer than usual weather. Most analysts expect that rising industrial demand, LNG exports, increased exports to Mexico, and continued coal to gas switching will push prices to $3.50 by mid-2017. Looking at the portfolio itself, if you look at the performance summary on page 2, total NAV at the end of the period, this is September 30th of 2016, was $5.3 billion. External portfolio was about $2.8 billion of that, or about 53%. The internal portfolio was $233 million, about 4%, and the rest was cash awaiting investment, about $2.3 billion, 43%. The external portfolio returned on a gross basis 1.97% versus 1.32 on the benchmark, so we outperformed the benchmark by 65 basis points during the quarter. The real estate sector of our portfolio was up 0.91%, infrastructure was up a healthy 3.62%, and energy was up 2.1% as the oil prices continue to rally. 1 year return for the external portfolio was 10.29% versus 7.30 on the benchmark, so an outperformance there of about 300 basis points. 3-year numbers, 12.74% on the portfolio versus 8.73 on the benchmark, outperformance there of about 400 basis points. And on the 5-year, the portfolio was at 14.97% versus 9.41 on the benchmark, outperformance there of 556 basis points. About 30% of our total existing capital commitments remained unfunded at the end of the period. 24% of that was in real estate, 41% in infrastructure, and 46% in energy. The internal portfolio had a very good quarter at 5.90% versus 1.77 for the benchmark. Their 1-year return is 8.74% versus 9.22% for the benchmark. On a combined basis, portfolio without cash was 2.29% versus 1.77 on the benchmark, so outperformed by 52 basis points. 1 year was 10.1% versus 7.30, an outperformance of 280 basis points, and the 5-year was 13.95% versus 9.41 on the benchmark, so an outperformance of 454. From a diversification standpoint, the combined portfolio was still generally over-allocated to real estate. However, that is gradually coming down as we make more and more commitments to energy and infrastructure. At September 30th, on an as-invested basis, the portfolio was at 42% in real estate versus a target of 33%. That's going to continue to change as more and more of the commitments we've made to energy and infrastructure become funded. For example, if you look at the allocations on an invested plus unfunded committed basis, real estate was at 35% versus a 33% target. Infrastructure was at 27% versus a 32% target. And energy was at 38% versus a 35% target. So I fully expect that that's going to continue to change, and by the end of this year, I think we'll be very much in line with our portfolio targets. From a geographic diversification standpoint, we're also very close to our targeted allocations for each geographic region. Currently, the U.S., excluding Texas, is about 85% of the portfolio compared to a target of 75%. The international allocation is now around 7% compared to a 10% target. And finally, the allocation to Texas is a little bit over 8% compared to a target of 15%. That is the end of the report. As I mentioned, it is a non-voting item, but I'm happy to answer any questions that you may have.
Any questions from the board at this time?
Thank you, Rusty.
Thank you.
Thank you, Rusty. That being a non-voting item, and before adjourning, I just wanted to recognize a few guests. Ben Williams from the Office of the Attorney General, Richard Coleman, an engineer from Stable Rock Energy, coming in from Houston, Texas, and Jack Moore is a landman with Trinity Energy Services out of Houston as well. Thank you for coming. We love having visitors. Appreciate you visiting us. And with that, we will adjourn today's meeting. Thank you.